I'll give a quick intro. My name is Mark Moeremans. I'm Senior Vice President of Entrepreneurship and Venture Development with the Arizona Commerce Authority. It's my great pleasure to host this panel today on structuring your cap table. This is a part of our broader Entrepreneurial Finance webinar series. We'll be back with another topic likely next month. And we really appreciate the support and turnout that these sessions are getting. Last month, we spoke about capital strategy. Quick takeaway from that was really about focusing on milestones and not raising money because you're running out of money. And if you have more questions on that, just email me offline and we can recap that as well. Before we jump in, I'd like to just take a minute to introduce our panelists who I could not be putting on this session without and who have a ton of really rich wisdom to share with all of you. Sydnie, if you'd like to go ahead and say hello and introduce yourself.
Absolutely. So I'm Sydnie Keddington. Quick disclaimer, I'm at the airport right now, so I'm fingers crossed I don't make an announcement in the next 30 seconds. But I worked with Kickstart Fund just outside of Salt Lake, Utah. I've been with the team for coming up on 2 years now. I'm on the investment team, and we are a seed stage group focused on businesses in the Intermountain West, so Utah and surrounding states, and a handful of companies in Utah as well, about 100 in the portfolio. 250 million under management across 5 funds. We just closed Fund 5 earlier this year, right before COVID hit, so very fortunate timing, and that was at 110 million. So we're thrilled to be actively investing in the region. Definitely reach out if you have a business that you're looking to fund. We love Arizona. Phoenix is a geography that I personally cover and am really passionate about, so it's great to be here. Thank you so much.
Thank you, Sydnie. Well, let's stick with Utah. Jeff, go ahead.
Great, thanks, Mark. Yeah, Jeff Erickson. I'm with Carta. I've been with Carta for about 3 years. For those of you that don't know Carta, we provide cap table management software. Have I think it's 18,000 companies now using the software. I'm also based out of Salt Lake City, and Phoenix is one of the areas where I focus on as well. I love getting down to Arizona. It's just been a while since COVID hit. So I look forward to getting back down there, and I love being part of the startup ecosystem there, which I see has tremendous potential. So appreciate you having me on, Mark.
Thanks, Jeff. Tyler, go ahead.
Thanks, Mark. I'm Tyler Lyman. I'm based in Phoenix, Arizona, or just outside of Phoenix anyhow, and entrepreneur and angel investor, and I focus primarily on social impact startups. My current startup is an energy-focused company that uses AI to figure out how to use less energy in a residential application.
Awesome. Thank you, Tyler. And last but not least, Tom Curzon, go ahead.
Good morning. Thanks, Mark. I'm Tom Curzon. I'm local here. I've been with Osborne Maladon for 40 years and doing startups for 38. And I wear an angel investor hat periodically and work as a venture lawyer, and I'm also chairman of Startup AZ Foundation. So glad to be here and helping out.
Thanks, Tom. So before we get started, a few quick disclaimers. We've got some topics that we'd like to cover, but if you do have questions, we'll try and save some time for those at the end. You can feel free to use the Q&A tool at the bottom of the screen. And the last kind of caveat is that this is a really rich, in-depth discussion, and we're going to scratch the surface on some really important topics. There's some things that we'll likely go deeper on in future sessions. So if you really want to learn the ins and outs of convertible notes or valuation, stay tuned. That's coming, but we'll definitely touch on a lot of topics like that today. If we don't go as in-depth, just tune in for the next one. So to get started, I'd love to just kind of talk about cap tables in general, setting the table here. Tom, if you could talk a little bit about who and when should they be thinking about cap tables? Does everyone need to kind of have this on their radar? Is it only certain types of founders or at certain stages that they really need to be putting energy into this?
Good question. So think of your cap table as a living, dynamic snapshot of your ownership and economic family, right, in the company. If you're a small privately held company and really aren't changing or adding shareholders or option holders, and your ownership is stable, your cap table isn't dynamic. And so you don't really need to focus on the kinds of things we're talking about today as much. But if you're in a growth company, which I think most, if not all of our viewers are either on the founding side or company side or the investor side, they're very interested because of the fact that as you add capital, that capital gets expressed and described in the cap table. And it's showing the ownership as it changes over time. I mean, I think that's the super high level mark. And think of it as the register of ownership, if you will.
Yeah, that's helpful. And Tyler, as a kind of serial founder, what are your thoughts and process for kind of setting up that cap table? How often are you kind of working within it for your current and past ventures?
Sure, thanks. I think it's really important for any founder that's going to be raising money to begin thinking about the cap table from the very beginning and the way they structure the organization, and have a strategy around managing the cap table, because your cap table tells a story about you as the founder, about the organization, about the health of your company and the investors that you bring in. And so I learned a few years ago about a philosophy that Fred Wilson talks about called the doubling methodology. And essentially, for each round of financing and subsequent financing that you put in place, you're doubling the amount that you're raising and you're doubling the valuation. And so a good rule of thumb when you're starting off with a seed round is your seed round is typically 20 to 25% of the company. You're selling about 20 or 25% of the company to seed round investors. And let's say you're doing a 20% $4 million pre-money, $5 million post-money round. Your next round is going to be $2 million worth 10 million pre-money, 12 million post-money, and then doubling each time. And as the entrepreneur, that's kind of the minimum threshold that you want to think through when you're thinking about how to strategize your cap table. How do we reach that next milestone when we raise money 18 to 24 months from now to make sure that our valuation is double what our previous valuation was? And in best case scenario, we're accelerating valuation growth, and so we're selling less of the company at a higher valuation. But kind of that minimum framework, it helps to really create your operating plan too, because now you can start to think through what are the operating parameters and toll gates that I need to complete in order to get to that next round, so that I'm not just raising money without an understanding of what the impact is going to be to the cap table.
Yeah, that's great, Tyler. And we're going to talk about benchmarks, standards, and terms in just a minute. But I love that doubling methodology kind of mindset, and also thinking from the start of what your strategy is as you're building your cap table. Jeff, I want to just ask you, if someone's starting out building it, I know Carta's a great software. They're kind of leading in this space, but a lot of founders, is it an Excel spreadsheet and that's enough if you're early stage? Is it a team of people helping? What are the kind of tools that someone has to have on them with them as they're getting started with this, or as they're really diving into it?
Yeah, great question, Mark. I think, what we see is founders early on. If there's just a couple of founders, they'll divide up the equity. And, Carta's made it real easy because there's a free platform as you're getting started. And there's some other free platforms out there, but to have it in software, there's some advantages to that. One, it makes it easy to model things out. So like Tyler was talking about, if you're going to be modeling out, what's the company going to look like after we raise our seed round? What's it going to look like after our A round? And kind of modeling things out like that, especially as you get into convertible notes and keeping track of all of that. Just having it on a software platform seems to be real beneficial for the founders. Also, a lot of times for their attorneys, but making sure that you've got, when you're updating things, that you're looping in your attorney is all really essential. So if you are using a spreadsheet, keeping your attorney informed. If you're using a software platform, you're granting access to that to your law firm so that they're working off the same version of the cap table that you are, and you don't have multiple versions of the cap table floating out there.
Awesome, thank you. And so you talked about convertible notes quite a bit, and I know for early stage startups, that's a kind of a powerful tool when they kind of are bringing in capital. And when we talk about kind of your history of structure and ownership, I'd love to talk a little bit about the nuts and bolts, about the pieces that go into that. And so Tom, Curzon, if you could talk a little bit about kind of the convertible note process or other forms and functions that show up on that cap table for early stage companies, and kind of warnings or things to kind of have in mind as they build out using different tools, financing tools.
Okay, happy to. So the basics. The ownership of the company is divided up. If it's let's stay with a corporation, common stock and preferred stock are your two basic classes. And in our startup world, you have common, and you typically have 1 or 2 rounds of seed preferred, and then you begin Series A, Series B, and so forth. The preferreds have special rights. That's what you think about those, and that's what investors want. Common typically has the right to vote, although that could be changed. And each of those has a percentage or an ownership interest in the company that fundamentally is indicated by the number of shares they own divided by the total. That's a little rough. So a lot of folks, I'm going to assume everybody on the call knows about convertible notes in general. Convertible notes are what I would like you to think about, they are unpriced equity. They are not really debt, even though they are debt in a strict legal sense. They are used to bridge from where you are today to a permanent class of equity. And usually they're used when you're in between valuation points, where you want to be able to issue stock at a valuation. As founders and company, you want it higher. Investors want as low as they can, or at least fair in their minds, which translates to low. And sometimes you're between milestones, and it's challenging to get agreement on price. That's the classic time for a convertible note. So think of it as a bridge. And most commonly, you will use it between the friends, fools, and family round, which is where you typically do have some common stock, and it's the early money. And then you go, gosh, we're not ready to price. We think we can get some achievements soon. And so we want to use a convertible note to bridge there. And that's very common. And then my recommendation is you try and get into a priced round as soon as you can get a fair price. And the reason I'm going to say that is because of the characteristics of the note. Market is an interest rate in the 5 to 8%, a term of probably 2 years, a discount, most commonly 20% of the price of the next round is the discount, although sometimes you'll see 15 or 10, sometimes 25, but the studies show that it is typically 20. And then there's usually a valuation cap, which is designed and intended to prevent runaway valuations on the upside, which investors are very unwilling these days to accept. So it's unpriced, but these investors are taking equity risk. And by taking equity risk, it helps you understand that they really don't want a note bearing 5%. What they want is stock in the company. Now, the cap table implication is that the note is going to convert at the lower of the cap, or 20% of the value. And the risk is you get a whole bunch of these, and if you haven't modeled it out and really come to grips with what the dilution is from that, then you run into surprises later, which we'll talk about more, I know, coming up. But anyway, Mark, does that scratch the itch?
Yeah, I think so. And then I'd love to toss it over to Sydnie to kind of connect the dots between those early stage kind of structures and process towards when it gets across your desk at the VC level, things can maybe get restructured or become a little bit more standard. Can you talk about kind of where Tom left off at the convertible area, kind of that bridge round until you get to a priced round at the VC level?
For sure. So yeah, I think Tom hit on really important points, and kind of obviously convertible notes are something that we see often, we're comfortable with. They allow you to sort of essentially punt more kind of difficult elements of the discussion to later on, and really kind of simplifies the process in the earlier stages. And so once we participate at that level, I guess maybe quickly to clarify, Mark, are you talking more about in terms of kind of next steps after investing at the convertible stage and what things look like upon conversion, or what
Exactly. So when it comes to you for maybe a Series A, and they've got a lot of investors on their cap table already at the convertible note rate, kind of how does that either get cleaned up through your investment, or what is kind of the format that your dollars take?
Yep. So, and we typically kind of, for context, seed stage is really our sweet spot. And so certainly common for us to see convertible notes at our stage. One kind of rule of thumb I would say is something that's sort of top of mind for me that I've seen a handful of times is the idea of taking on multiple convertible notes at different caps and under different terms. And that's where things can start to get really messy. And so I would say, as a rule of thumb, being really mindful around how you're taking in these convertible notes and really understanding the implications on you as a founder. And this is something that I think actually gets overlooked pretty often at the founder level. It gets pretty complex pretty quick. And so it's important to really do your homework around, okay, what does this mean for me from a dilution standpoint in particular in the future? Really assessing and analyzing kind of again, what the implications are of the notes. I would say at a high level for us, and for most investors, the simpler the better in terms of structuring the cap table, and that it goes for convertible notes as well. And so I think just kind of saying simplicity is key, really being aware of, how many investors do we have on the cap table, and what's the cleanliness. I think that when we look at a cap table, it can be an implication of founder sophistication, and obviously there are a lot of nuances to navigate. And so, as kind of hit on earlier, having a really good venture lawyer is something that's critical, I think, at the, when you're forming your cap table and making these early decisions, because many of these early decisions do impact the discussions on the fundraising path at the Series Seed stage, Series A stage, and beyond. And so these are things to really be thinking about. And I would say, I guess the last thing I'd hit on is there are instances where, I think cleanup is possible. It just can get very expensive and very painful. And so I would say, if you're in a situation where, if you're listening to this discussion thinking, oh, maybe I've made some of these mistakes, don't panic. There are ways to clean up, but there are, especially if these are decisions you have not made, be mindful around how much easier things can be if approached in the right way early on. And so I would say, in general, kind of the bar maybe is a little bit higher if your cap table is messy or hairy, so to speak. And that's kind of the way I think we tend to think about it is, hey, it's definitely a factor of consideration for us in the diligence phase, among many other things. And so there's, again, ways to resolve problems that have arisen, but definitely life is much easier if things are executed in the right way. Did I hit on the right things there, Mark?
Yeah, I think so. And we'll get into a lot of that in just a minute. I just want to answer, there's a few nuts and bolts questions that have come in on this topic. And so one is, seeing deals structured as convertible notes or safes. Sydnie, do you see many safe agreements at the seed round? So probably worth kind of just touching on, between Sydnie and Tom, what you're seeing between convertible notes and safes.
Tom, feel free to chime in as well, obviously, but I would say it seems that there's actually a trend toward safes a little bit more commonly in the recent years. So I'd say historically convertible notes are more common, but safes are becoming increasingly more common, a kind of more popular way. They're very, obviously simple and pretty founder friendly, generally speaking, and can really expedite the process early on. So generally speaking, I'd say trending toward more and more safes, but probably notes are more common still today. What do you think, Tom?
Yeah, I think notes are most common. I think safes are not unusual. One word of caution to everybody: safes are actually no more or less complex than convertible notes. It's kind of a bunch of hype that Y Combinator created to push them. You can't just take their form and sign it and be safe, to make a bad pun. You actually have to read it and probably get a little bit of help with it, because there are nasty surprises if you're not careful on both sides, both for investors and for the company. I personally would rather invest in a convertible note than a safe. And I think most people understand them better. Mark, can I also add one other thing? Because I know I saw it flashed across the screen and I've got a quick answer for it for everybody, which was, there was a question I saw about market rate of interest on notes. I want to call everybody's attention to, it just came out last week, a new survey by the law firm Fenwick and West out of the Bay Area, surveying on convertible notes. And so they've got 100 or more transactions they've surveyed. And so they've got a real nice collection of data on what market is, both on caps, on term, on interest rate, on discounts, the whole 9 yards, and not just for pre-seed rounds, which is really what we're talking about, but for bridging rounds after that. So I think that Arizona market, in my experience, is pretty consistent with the market they describe in that. So I would urge everybody, if you're currently thinking of doing a round anytime soon, to Google Fenwick's convertible note study.
Thanks, Tom. And there was one more quick question I think we can answer around convertible note holders. Are all of them on the cap table? Or is there a way to kind of group them? Do some not show up? Tyler, I see you laughing. Do you want to go ahead and chime in? Oh, sorry, you're on mute, Tyler. Oh, Tyler, you're on mute.
There we go. Yeah, that's actually what I was going to comment on. Regardless of whether it's a priced round equity or a priced equity round or a convertible note, you need to make sure that they're all on your cap table. I think what happens a lot of times is people will do multiple rounds, like Sydnie talked about with a convertible note, and hopefully the terms are consistent. But when they're not all on your cap table, sometimes you can lose track of what percentage of the company you've actually sold off. And so while a convertible round isn't a priced equity round yet, there is a worst case typically with a cap. And so you put that in into your cap table. And as you get closer to that priced round, you can adjust that. But it's really important to track convertible notes in the cap table, just like you would a priced equity round, so that you really understand how much equity you've sold off in each round, and can plan accordingly so that you don't get behind the fundraising curve, so to speak.
Your lawyer will also tell you that it's a securities disclosure issue. You need to have all notes and any other kinds of investments fully disclosed, and it's typically from the cap table that you start.
So these are great questions, and we'll come back to them if we have time at the end. I do want to talk about terms, benchmarks, standards, because I think that's something that people try and maybe get clever with. And I know that we've seen some crazy things both inside and outside of Arizona. And so, Jeff, I'd love to just talk to you about your perspective on when to get creative and when to just follow a template.
Yeah, you do see one of the mistakes both investors, early stage investors and founders make, is complicating things. Keeping things simple, especially at the early rounds, is really makes a lot of sense, because what you have to realize is you're going to be raising, if you're going to be raising future rounds, the last thing an investor wants to see is something out of the ordinary, something that's really weird that they haven't seen before. That's going to throw up red flags and bring a lot of questions. So I think Sydnie alluded to it, that if you can keep things consistent on your notes, if you can keep things standard, it makes raising money down the road a lot easier. In fact, I saw a recent blog post from Fred Wilson, who said, as an investor, he'd be fine just having the founder say, hey, why don't we just use a standard form that Osborne Melvin puts out, and you guys use that, and we'll look it over, and we'll just agree that that's a good standard form to go with for our seed round, or even a Series A potentially. So I think standardization is looked upon more friendly, especially from future investors.
So thank you, Jeff. Tom, in this community, or kind of in your experience, where are some areas that you think we could improve standardization, or kind of what are some benchmarks that we should try and align around, either with terms, things like that, that maybe for founders, first-time founders listening in, say, this is something that I should stick to versus this is an area where I can be flexible?
Oh, that's a hard one to get my arms around. So I agree completely with Jeff's point of staying simple, and Sydnie made it too, and staying to mainstream. So one thing to do is to look at the surveys that are available both from Fenwick and Cooley and Wilson out of the Bay Area on what are the current terms, and try and stay very market. There are standard forms that are increasingly used that are put out by the National Venture Capital Association. And I know our practice and a number of other firms is, where possible, is use the standard NVCA forms. At the seed level, there are some good seed preferred forms that are worth looking at, including Y Combinators. I think that the danger for founders is, this sounds self-serving, and I don't intend it that way at all. There's plenty of good lawyers out there you can talk to, but this is not a do-it-yourself drill. This is get help, particularly get help from lawyers who know what they're doing and know what the market is, so they can help guide you into staying right down the lane, the center of the lane. Because what Jeff's alluding to is, if you wander off and start doing things that are non-standard, it'll cost you a bunch of legal fees, because it'll get fixed and it'll get dealt with down the road, and it may be friction in deals and could end up stopping deals. So I think the best and easiest way is, do some reading on the surveys, do some reading to educate yourself on what terms mean, but then talk to a good venture lawyer and ask them, what's market? What's happening? What are getting deals done? And talk to several lawyers that, like I said, but this is not amateur hour. If you want to really impress investors all the way along the road, what you need to have done is pulled a good team around you, not just lawyers, but just your board and advisors and the whole 9 yards, and be smart. And your cap table is an area where it's especially important to be smart, both in how you manage it. We'll talk at some length at some point on it, your stock option plan, doing all of the things around that right, and then structuring your rounds as you go in a smart and forward-looking way as you think, you're preparing for the future. And I think Tyler alluded to this as well.
So Tyler, you did mention the doubling methodology as a good kind of benchmark to start with. Are there other kind of, and feel free to talk about that a little bit more, or are there other benchmarks? I know we've talked about kind of board seats becoming a negotiation item, or preferred stock becoming a negotiating item that starts to move us maybe outside of standard. And so I'm wondering kind of what you've seen, or other benchmarks that you should maybe stick to around these term sheet items.
Yeah, well, just like the doubling methodology, I think the more structured and standardized you can stay through the process, the easier it's going to be to raise money in the future. When you start to get really creative with terms or documentation, it like your cap table, it tells a story about you as the founder. It tells a story about your company and the investors that you brought on to your cap table. And so trying to stay very consistent and vanilla in those documents will help in subsequent rounds. It also helps in negotiating the current round, because if you're using market and standardized forms, as Tom mentioned, it's a lot easier to push back on investors who want to get a little bit crazy with some of the things that they want. Whether, a seed round, an early stage investor who's putting in a small check, wanting to be on your board, for example, you really have to evaluate whether or not that person is going to bring value long term, because you have a finite number of board seats that you want to be able to give out over the course of raising capital. And if you've got somebody on there who put in 1 or 2% of your seed round, it may not make a whole lot of sense. And it does tell the story to future investors as they look at it. One of the first things that I look at when I'm looking at a company is their cap table to understand how well did they negotiate early on? Did they really understand the flow and process of money as they were taking those early stage investments? So the more you can stay standardized, the better. In terms of benchmarks and things like that, for a SaaS or software-based company that I've typically built and try to stay focused on, that seed round, you want to go into your A with about 20 to 25% of the company investors. I try to set up an employee stock option pool of about 10% prior to that Series A round, and then it becomes measuring and monitoring dilution becomes a lot easier. You can do that through tools like Carta that just make that whole process a lot simpler as you move forward, and you don't have to clean up a mess, as Sydnie talked about.
Got it. So I want to move a little bit towards kind of fun, hot topic questions or topics, which is valuation and dilution, which are inextricably linked to the cap table. And so I know that everyone gets really excited about valuation. I'll hand it over, I think, first to Tom. If you want to just talk a little bit about how do you balance getting that big number at the front end of this is what we're worth versus this is how much I own of what it's worth, and when those thoughts and processes come into cap table discussions.
You bet. So let me start with the pie speech. When we talk about dilution, there's two kinds of dilution. There is the numeric dilution that comes from every time you issue shares. Because you always have 100%, there is always numerical dilution anytime you issue new shares. Nothing wrong with that. It's just a fact of life. That's what happens because of the math. The other kind of dilution has to do with value. And really what we want is what's called anti-dilution. And what that really is the pie getting bigger. And it's the simple thing. The question to you becomes, do you want to have a big percentage of a small pie, or do you want to have a small percentage of a big pie? Building growth companies tends to be more of the mindset towards building a bigger pie and recognizing that you have to share slices of that pie with your management team and with different rounds of investors. And so the only way that makes economic sense is if you're growing value. And so the trick that I think, and it's not a trick, the mindset that Tyler's been referring to and Mark is alluding to is what we talked about in the capital strategy session, which is that you want to, in terms of your investor capital, you want to think about issuing it in stages and in amounts that are appropriate to achieving milestones along the way that support a higher valuation going forward. And this is where Tyler's 20% rule of thumb is helpful, because it helps you have a context that if you do a seed round at 20%, but you're at a $10 million post-money valuation, then you're talking about a $2 million raise. The question then becomes, is $2 million enough to achieve important milestones, and what would they be so that you could do another round? And at that round, if you're thinking about doing another 20%, which would be typical, are you at a high enough valuation where you can now raise enough money that, again, you can achieve milestones? Obviously, higher valuations yield more money, et cetera. And it's not a rule that you do 20% each round. But the reality is, professional investors, you will almost always hear them say, I want to invest 10 to 20% or 10 to 25%. So you're going to end up very often in the 20% range and thinking, okay, I don't want to do more than that. And can I get a valuation that lets me accomplish what I need to accomplish? So it's this balancing act between achievement and dilution and valuation. And ultimately, it's all in the service of the pie.
Sydnie, I'd love to get, oh, go ahead, Tyler.
Sorry, I think Tom brings up a really good point, and that is that you can't disconnect your cap table from your operating strategy. You have to grow valuation. As you're diluting each round, that valuation becomes really important, and so your operating strategy has to focus on how do we meet those future milestones to achieve that valuation growth, and whether that's revenue growth or whether it's traction and development or whatever it is, that will differentiate and help you to validate that valuation. I think it's really important to connect your capital strategy or your cap table with your operating strategy.
Yeah, there's a joke that I always like that says, from an investor perspective, you set the valuation and I'll set the terms. And Sydnie, I'd love to hear your perspective on how much time you spend kind of talking with founders about valuation. And I know a lot of founders want to get a specific number because there's a PR bent to it, or how much time they spend thinking about potential dilution, how you guys interact with that as VCs.
Definitely. I think generally, like principally speaking, and I think this is, I would imagine how many VCs approach it. Certainly our position is ultimately we want to come to a point where we feel both we and the founder that we're about to enter into this sort of startup VC marriage with are feeling good about where we're at on the negotiation. And so I think at a high level, it's something that's important to us, obviously, that we've hit a number that makes sense for us, investors always have a target ownership that they're aiming for. And so there are instances where the deal doesn't go through because it just doesn't make sense for us economically in terms of what we will own moving forward. But I think that being said, we tend to take the approach of what makes sense on both ends. What are the kind of factors at play, and what's important here in terms of structuring the term sheet. And so it definitely sort of they toggle. I think there's definitely they go hand in hand, and they're very much in tandem. It's there are a lot of levers that we can pull kind of in tandem with the founder to get to a point where this makes sense for the business. The founder is sufficiently motivated, because that's in our interest too. Like in reality, we obviously, again, have a target ownership, but we also want to make sure that incentives are aligned. And so I think to a point that was made earlier, it is important for founders to be thinking about what are the milestones that will be required. If this is if I am at X valuation currently, what milestones will I need to hit to justify X valuation in the future? So just be careful not to back yourself into a corner in that regard. But I think definitely, like having incentives aligned and having trust-based relationship conversations around that topic are kind of how we tend to approach it. And I think a lot of VCs take a similar stance.
Yeah, and we'll definitely talk about incentives in just a minute. I do want to talk, one thing that came up in our planning session was around what I'll refer to as kind of unintended dilution. And so we spoke about relying on convertible notes for too long, and how that can kind of affect founders or companies. We also talked about kind of stacking preferred options. And so I'll kind of open it up to the group if you want to talk about those things, how they happen, what the long-term impacts are, how that kind of can relate to dilution. I'll just open that up.
Yeah, I can talk to that for a minute here. One of the common mistakes you do see early stage founders make is leaving a note round open and taking additional capital. Sometimes you see that you intend to raise $500,000 in a safe for a note, and there's more money available, and you've got a cap and or a discount rate associated with these notes. And because the money's available, a lot of entrepreneurs will say, hey, well, let's take more, and they'll keep that round open and keep taking more and more money under those terms of the note round, without realizing that they're giving up significant equity with every check that's coming in. And what happens a lot of times is the founders are shocked when the Series A closes and those notes convert, and all of a sudden the dilution hits, and they're surprised. They're saying, we didn't realize we gave up that much equity. And so I think, again, staying on top of things and making sure you're you're capturing all the information about the notes and factoring that into your fully diluted cap table is critical as you're planning ahead, and helps you to not make mistakes like that of giving away too much in an early safe or convertible note round.
I would like to add to that, kind of exactly adding to it in the sense that what I think a lot of companies don't realize, that when they get to a priced round where the investors, particularly institutionals or sophisticated angels, are negotiating for a specific percentage of the company, and let's say that they want 20% of the company on a post-money basis, all of the notes and safes and everything that's happened before will come out of the 80%. So the founders, when all that's rationalized at the closing and the new investors have their 20%, the option pool, the notes, the safes, and the founder stock are all compressed into that 80%. And that's where the surprises happen. And this is why it's so important for founders to have spreadsheet skills and or use the Carta tools to stay on top of what does the hypothetical priced round impact really going to be if they go more and more and more of the unpriced equity in the form of notes and safes. The other thing that strikes me, Mark, that speaks to your question, and it fits in the discussion earlier about staying standard. Sometimes, in particular, angels will want to come in and want to have a type of preferred stock that is basically double dipping, where they would get their money back and get their percentage ownership of the company. It's called participating preferred. It's not actually market these days. Market is a non-participating preferred, where they get their the higher of their money back, and maybe a coupon, or their ownership interest in the company as if it converted to common. That's a kind of term that actually is a pricing term. It's not just something detached that sounds like an investor bell and whistle. It's actually about pricing, because it has to do with ultimately how the proceeds of a sale are ending up shared. Simple example would be if you've done $10 million in a participating preferred for 20% of the company, and you sell the company for 50 million. When you sell it, there's two prices. The investors, it's 50 million. They get the first 10 million plus 20% of the 40. For the founders and everybody other than those investors, the price is 40 million, and they get their remaining 80% of the 40 million. That's the kind of term that can creep in and have a dilution impact that can be a surprise if you're not up to speed on what the terms are.
I think that's a really good point, and why it's really important to have a lawyer involved to help you understand that, because liquidation preferences might not be something you're looking at from a valuation perspective, but have a big impact. And Mark, on the topic of unanticipated dilution impacts, there's a question in Q&A I think that's important too. Is it problematic to overprice an early stage round, or a high valuation in an early stage round? And I think that it is, both from a founder perspective and from an investor perspective, because if you're looking at kind of this structured approach to your cap table and you're doubling each time, if you overprice the first round, it increases expectations and where you need to get to the next round. And so oftentimes as a founder, it's counterintuitive to think, well, if I can get that valuation, to have a little bit lower valuation, take a little bit less money, or to take less money early on, so that I don't necessarily have to have that higher expectation and threshold or toll gate to reach for the next round. And so as you're thinking through unintended consequences of dilution, if you overprice the first round and you can't reach that doubling threshold, then you're gonna see further dilution beyond what you had anticipated in that next round, and potentially for the next couple of rounds. But
And
so
Tyler,
I think it's not just about pricing it, but it's really about looking at it long term each round, so that you're not putting yourself in a hole early on.
And that brings us, so I want to cover one more topic before we kind of address all the Q&A that's come in, which is kind of why it matters. And so Sydney and a few others have mentioned incentives and motivation and things like that. And so on the investor side, we talk about participating preferred stock and why that might impact incentives and motivation later on. And also on the founder side, I know that we've all seen kind of horror stories of what a messy cap table can do. So Tyler, I know that you've got some stories of seeing what happens if someone isn't watching their cap table closely, if you'd like to share that.
Yeah, and I think it starts from an operating principle perspective. I think for a lot of founders, whether it's circumstance or market trends, they find themselves in the enviable position of being able to raise capital at a good valuation, and they're able to raise a lot of money. And now they have this big chunk of money sitting in their bank account that they don't necessarily know what to do with. And so you have to go out and spend it. And if you have this idea, each tranche is 18 months of runway or 24 months of runway. You're trying to spend that money as quickly as you can. And what I've seen a lot of times, particularly with companies that raise a lot of money early on, is that they put themselves in a situation where they've spent the money and haven't necessarily achieved the traction or the product market fit that will help them reach that next milestone and next fundraising threshold. The other thing is that it doesn't always make sense if somebody's willing to write a check for a higher percentage of the company. If you want to, in your seed round, if you want to raise $1 million at a 20% priced round or convertible note, it doesn't necessarily make sense to take $2 million for 40%, because you want to, ideally, that extra $1 million that you're taking, you're going to see valuation accretion, you're going to see valuation growth. And so you're selling at a discount that second $1 million. And that's one of the things I see pretty common, particularly with early stage companies that are in that enviable position of being able to raise more money, is they end up raising more money than they need. They end up selling a higher percentage of the company at potentially a discount. And then if they can't achieve that next threshold, it makes it that much harder to raise subsequent rounds. So I think it's really important from a founder perspective to look at it, not just from how much money can I raise today, but how am I going to spend that money and what is the flow of money going to do to help me achieve the next round? Because it always takes more money and takes longer, but you want to get credit for that traction that you create in the short time and within that tranche of investment that you're putting forward. So I think it's really important as you look at each round to not only look at how much money can we get and how far can we get, or how much runway does that give us and what does that do from a valuation perspective, but can we do it with less and therefore increase our valuation for the next round and not give away more of the company.
Jeff, you had mentioned being able, like the cap table tells a story, right? And so what are some of the things that either investors or advisors or mentors, employees might be able to read into in that story, or what can you learn from that cap table?
Yeah, it's interesting because a lot of times founders will think that it's just the ownership percentages and that's all it's showing. But investors are going to be looking at your cap table. In fact, that is one thing that you can count on. Every investor is going to want to see your cap table. One of the reasons is they can see a lot about, one, the founders. If you've got errors in your cap table, first, it's going to throw up red flags immediately, because you're talking to an investor that's going to be trusting you with their investment. They want to make sure that the cap table is accurate, one, because they need to know what they're investing in, and two, they want to make sure that you're keeping good track of their equity as well and you're a good steward. And so errors in a cap table are definitely a red flag for investors. The other thing that founders don't realize is that you can kind of see the culture of the company as well. So if the company has, a stock option plan, the investors can start asking questions like, okay, well, why is this person on the cap table and why did they leave? there's all kinds of things and insights that investors can get by digging into the cap table. It gives you a good history of what's happened in terms of capitalization for the company historically. So, be very careful on who you let on your cap table is one word of advice. Investors will look for who else is on there. If you have an unreputable investor on your cap table, again, that's going to throw up a red flag. If you have a really good investor and with a great reputation, that will be a positive signal. So who is on your cap table, why people have left that have equity, those questions will always come up. You can really tell a lot about a company and a founder just by viewing their cap table.
And Sydnie, as an investor, yeah, please chime in. What are you looking for? What do you see? What are the red flags?
I think Jeff hit on really important things. And then one other thing that hasn't really been touched on yet that I think is important to mention, because we see this actually pretty often, is advisors and giving equity to advisors. I think that this is one where oftentimes bringing an advisor onto the cap table is a function of resume strength and perceived resume strength. And I think that it's really important to be mindful around, okay, what is this advisor truly bringing? What deliverables are they committing to? What is the communication cadence? And are they truly, motivated to contribute in meaningful ways to the company? Because unfortunately, there are a lot of instances where that's actually not the case. And so I'd say be really selective on who your advisors are. Common shares across the board for advisors. Same goes for founders. I think I saw a quick question in the chat about that as well. So common, definitely at the advisor level. And I would say really being conservative around how much equity you're actually distributing to advisors. That was one quick thing that I think hadn't been mentioned that I think is worth touching on. And then one thing that I don't feel like we've touched on as much, and this is just a quick note as well, and sort of a deviation, but just company, how is the company incorporated? And so being thoughtful around, is this a corporation, C Corp? Delaware C Corp is definitely what we typically want to see, and we'll make it a part of the term sheet or a requirement that for a convertible note, upon conversion, the company commits to converting to a C Corp at a price round that's to be expected as well, that already is established. So those are a couple additional thoughts that come to mind for me that I think are valuable.
I appreciate that. And we're almost at the hour, so I'm going to do some rapid fire Q&A. And then if someone's got an answer for any of them, just go ahead and chime in. Similarly, if you've got any horror stories that you think the community can learn from, feel free to chime in with those as well. But we can try and go through these quickly. And then if people have time to stay on, I'll hang around for a few more minutes. I don't know if any of our panelists are able to as well, but there's some great questions in here. Do investors frown upon founders owning preferred shares?
Not if they've put in cash dollars for the preferred. If they've bought preferred with money, just like the investors, I think that's okay. If it's preferred for founder shares, that starts down the path of complexity and questions and friction.
What is your advice to investors and founders when a bridge convert requires a maturity extension? Are investors due a sweetener?
Well, I think a sweetener, or whether it's warrants or any other type of anything else that's going to further sweeten an investment, just tells the story of where the company's at. As Jeff talked about, whether it's who's on the cap table, the number of rounds, the number of convertible notes, bridge rounds, things like that will tell the story for future investors. And it may be that you just struggled to find product market fit and now you've reached it, or it might be that you just haven't clearly or strategically thought through how much money it's actually going to take to deliver product market fit.
I agree. It's very contextual, and it depends on the reasons why. If they're at maturity and things are going great, and they just want an extension for some positive reasons, maybe a sweetener makes sense. But if things aren't going well, what are the investors going to do? Shut the company down? I mean, that's the real question. Or are they going to pitch in and help find investors an extension round or the like? So really, the answer in my mind to the question requires just considering what are the facts and circumstances and what makes sense in terms of the company's future and the investors' investment and the like, and don't be short-sighted.
As the cap table evolves, who do you share it with? Does everyone on it get to see it? How frequently do you pass it around? Do senior executives also get to participate in kind of seeing it?
You know, I'll say I think there's a trend towards transparency, and hopefully there's a trend towards education for, you know, employees and others that are receiving stock options, so they actually understand what they're receiving. And if you look at it, stock options are meant to be an incentive. And so if the employees don't understand what, you know, 300 shares means, are they really that incentivizing? So I think you do see a trend towards transparency, at least for, you know, the percentage you own. As an employee, I would want to know what those 300 shares or 30,000 shares represent in terms of percentage of ownership. I think it's fair to ask. Some companies may be more transparent than others.
And I like transparency from this perspective that it forces the founder to really be conscientious of who he's putting on his cap table, what they're doing for each round. It makes you just ask the question, if anybody saw this, would I be okay with it? And so it's just one more step in trying to create accountability around it.
And are there risks to omitting information from a cap table? Do you need to include absolutely everyone? Or if you've had bad actors in the past, can you start to hide them? Or similarly, how often and how do you recap?
Ooh, there's
Well,
lots
I think
of things in there. I'm going to say talk to your lawyer.
That's a great answer right there.
Yeah, I do like to, you know, if I have a number of small investors, I try to put them into a syndicate early on, so that it doesn't necessarily clog up the cap table. So you don't have 20 or 30 small investors. If you're raising friends and family, you might put it into a syndicate or something like that, which does create a little bit of a gap in who's in that syndicate. But certainly not, you know, not putting in source information of funds and things like that would be a red flag.
Yeah, and I don't want to be too clever in my response. I agree with that. I think a lot of times summary cap tables are used for disclosure purposes, at least initial disclosure purposes. If an investor prospect wants to see the entire cap table, then you should provide it. And I'm serious about understanding your disclosure obligations relating to material information around the company, and there's nothing more material than the cap table. So my personal reaction, if I found out that a company was hiding anything off the cap table, you know, I wouldn't invest a nickel in that company. I'd run the other way, because that is a signal of a mindset that is not somebody I want to invest in.
And I've seen that in the past where a sweetener was added for warrants with a convertible note, and the warrants weren't on the cap table, and it went a couple of rounds of further financing before they got included in the cap table. And so the dilution impact to people who came in without knowing that those warrants weren't on the cap table was pretty significant, and it caused a lot of heartache and pain among the investors of that organization.
Can you discount can you negotiate the discount percentage on a convertible note, or do you stick with a market standard?
So I've got a suggestion in that regard. Yes, it's negotiable because it's your company. You're having to agree to terms. So there's two levels of answers. I think that if you want to negotiate, you need to recognize you're creating friction. So the deal may go slower, and you will negotiate to whatever outcome you're able to, depending on the strength of what you're offering. Having said that, the typical technique that works, that I find in my experience that works best, is you working with your counsel come up with a proposed term sheet if you're dealing with angel investors in particular, and you find a lead investor and you negotiate with them the terms of the deal, and you propose what you propose, they propose what they propose, and you establish it. Once you establish it, then those are the terms, and you go out and you raise the money based on those terms, and you don't renegotiate along the way. You can help it because you have securities law disclosure obligations around any change in the terms. So yes, it's negotiable, but be smart about how you approach it, and keep in mind the points we've been making throughout this, that to the extent you are deviating from what investors expect, you make it more difficult to raise money, unless you're selling, the greatest invention in the world. And most of us aren't.
So
I think the other
oh, go ahead, Tyler.
I was just gonna say, the other thing to keep in mind with discounts is that the discount is the fallback position. Your price cap is typically where your target is. And so if it's a $5 million post-money round with a 20% discount, you're converting at the lower of whatever those two are. And so it's important, that ideally you're converting at $5 million and not a $3 million round with a 20% discount.
Well, it's 12:02. We're a little over the hour. I want to thank our panel for this really rich conversation. Tons of wisdom and information in here. Thank you to our participants that have stuck around. If you do have topics that you'd like to see in the future, or any of these issues that you'd want to dive deeper on, feel free to shoot me a note. I'll type my email in the chat window. Would love to hear from you. But before we close out, if there's any kind of final thoughts or recaps, no pun intended, from our panelists, happy to leave you with the last word before signing off.
Mark, one thing that I'd just like to emphasize, and I tell all the founders I advise, is make sure you get a good attorney right out of the gate, a good startup attorney. One of the biggest mistakes I've seen is to delay that decision and to do everything on your own and then go back to an attorney. You end up spending a lot more money cleaning stuff up than you would if you just get a good attorney that can review things before you actually do them. And I think that relates to the cap table, because they'll give you some good advice on how to structure things and the path to go down.
And I would maybe just also add, really do your homework with prospective investors, and be wary of investors who are pushing for non-standard terms, who are being, tricky with different elements of the negotiation process. You want transparency, you want trust. That's obviously critical. It's a very important relationship, and you're in it for the long haul. So just be thoughtful around that as well. I think this is just a critical discussion. Really, really happy to be part of it. Something that really impacts, again, the future of the business. And so hopefully this was helpful.
And I would just add that the cap table isn't anything to be afraid of. It's really a great tool as you're negotiating and raising money, and continue to use it and bring investors on that are going to be accretive to that process.
I agree with all that, and I would just encourage all founders to fully embrace learning the mechanics of how to do the spreadsheet work, to understand how all of that works. And so you really deeply understand your cap table. You'll be a better negotiator down the road, and you won't get it. You'll reduce the likelihood of surprise.
Thank you so much to all of our panelists. Great advice, and looking forward to the next one. See you all soon, and stay on the lookout for information for our next webinar in the Entrepreneurial Finance Series. Thank you, everyone.
Thanks, Mark.
Thanks, Mark. Thank everybody.